Hello and welcome to Business Talk TV with me, Greg Wright. We're delighted to be joined today by James Andrews, who's a director at Leeds-based Redmayne Bentley. We're talking about one of the biggest issues facing the global economy at the moment. That's the topsy-turvy performance of the stock market in the US, UK and overseas, with significant falls then followed by an apparent correction in the market, and many people are concerned about what this means for them as an investor. James, thanks for joining us. The first question is, what does all this tumultuous events of the last few days tell us about the global economy?
Well, actually, it's somewhat perverse, really, that actually what's triggered this fall has been positive numbers in the US wage area. US wages have grown slightly faster than expected. And what that's done is actually triggered a bit of nervousness around investors in the US, because wage growth potentially leads to inflation, potentially leads to greater increases in interest rates. And that's really what the market has focused on, is the Fed going to raise interest rates faster than expected? Now, what that means really is the knock-on effect is increased cost of borrowing for companies, and potentially mortgage rates go up for consumers in the US, etc. And you're probably going to ask me, well, what on earth does that have to do with the UK stock market, which also fell, and indeed Europe? Well, the answer is not a great deal, really, other than the fact that we've had this very long bull run. We've had very low volatility, and markets perhaps, or investors perhaps, been looking for an excuse to take some profit and have a pause for breath. There's also been some technical issues at play. I mentioned volatility. A lot of people, because of this very calm market that we've had over the last year, 2 years, have placed bets against volatility coming back. So when the opposite happens, they have to basically play the other side of that bet, and that means going short equities and buying back the volatility. So there's been technical parts to this, but the long and short of the story is that it feels like a pause for breath.
It's been a very, very strong period for the stock market globally, with record highs. Is this simply a correction rather than a rout of the market, do you think?
It feels that way. The market today has bounced back a little bit. The FTSE, when I left my desk, was up. FTSE 100 was up 1%. The US was actually forecast to open down a little bit, having bounced itself last night. It'll be interesting to see how this plays out. What I think it perhaps healthily reminds investors is things don't just go up in a straight line. Volatility is a natural part of the equity market, but generally speaking, we are at a point where global growth has actually synchronized for once. Companies' earnings are growing well, so it does feel like a little bit of a profit-taking, pause for breath, but not a complete market crash, as it were, just a bit of a correction.
Because what's driving this to a large extent is the really strong performance of the US economy. Now, in global terms, obviously, if the US economy does well, in general terms, other companies do well. So that could well mean in the longer term that corporate profits are up, and therefore that's very good news for shareholders in the UK.
Yeah, the FTSE 100, 70% of earnings are derived from overseas, as opposed to the UK. I mean, the UK is the one perhaps slightly less positive story in global growth terms at the moment, because of the uncertainty triggered around Brexit and our political situation. So actually we're forecast to be one of the worst in the G7 in terms of growth. But globally, growth is expected to do well, and yeah, that should power companies' earnings, which we've seen in the US, very positive numbers. So I think valuations have got stretched. There's been this bit of a surprise here in the number from the US wages. It's just an opportunity for people to take stock of things, maybe pull those valuations back a little bit, a bit of a pause for breath, but I don't expect it to be the complete end of this bull market just yet.
It's interesting as well, because we've become so used to interest rates being so low for so long, and it's a generational thing. The last decade they've been literally on the floor.
Yes.
At some point these rates have to go back up again, and it's going to be a slow process, but it will happen. What should you do to prepare for this in general terms? Because so many people are used to low interest rates. I mean, how should you prepare yourself financially for this? Because in a time when, you know, money was cheap, if you like,
yeah,
it was much easier to get the things you wanted. Do you think people may need to rein in some spending as things become slightly harder in terms of the interest rate environment?
Yeah, I mean, I certainly think that it pays to cut your cloth accordingly, as it were. Interest rates, borrowing has been very cheap. That can't continue forever. And that, for me, is going to be the key trigger of what changes this market dynamic. And it's probably what spooked investors in the US. In the UK, for us, we've got interest rates at 0.5%. Inflation, whilst fairly high, CPI is at 3%, RPI at 4.1. That's fairly toppy, but what we've had the benefit of is the strengthening of the pound against the dollar and other currencies, which, if you reflect back to Brexit, that was one of the causes of this inflation, was the fall in the pound. We imported a lot of inflation. Costs were going up. So this should offset that, ease the pressure on Carney and the Bank of England to raise interest rates just yet. But that won't be forever. We will have to see interest rates rise and normalise at some point, and that could well be the trigger for markets to come back a little bit, for people to go, okay, my cash in the bank is actually earning a reasonable return now. I can move it out of more risky assets such as equities.
Is there anything the Bank of England could do to sort of enhance confidence at the moment? People are talking about Mark Carney making a statement about the possible movement of interest rates. A clear signal from them would be quite helpful in many ways.
It certainly would. The markets and ourselves as consumers hate uncertainty. Businesses hate uncertainty. They like to be able to make decisions knowing what the future holds to a certain extent. It's why a lot of us fix our mortgage rates, all that kind of thing. We want to know what's coming up over the next few years. So yeah, any guidance that Carney can give around where interest rates are likely to go in the near term would be well received by investors, and I'm sure consumers as well.
And finally, in terms of the Yorkshire market and the Yorkshire economy, when you speak to people, how do people feel about the overall performance of the economy in Yorkshire?
I think people are fairly positive. I think London has been hit by this by Brexit far more. I think they voted very differently for a lot of the country. I think for us, we've got a very powerful local economy. There's probably not as much link services, certainly on services wise, cross-border services, unlike sort of the investment banks in London that use basically London as a way to passport into Europe. So it's a different economy. I think the one thing is the manufacturers, that whilst they're benefiting or have benefited from the fall in the pound, they do have greater uncertainty than other areas of the Yorkshire market, because they don't quite know what their trade terms look like. So in general, I think it's more positive than perhaps the London kind of story. And the sort of more inward-looking economy is looking fairly healthy, but certainly those people manufacturing and trading are still worried about what their terms look like going forward.
James Andrews, thank you for joining us.
You're welcome. Thanks very much for having me.